One is people on those long bonds lose value, existing
Yeah.
holders. I mean, people that are buying now get a better deal. And then two, it ripples into other asset classes as well. And so it's one of those things where normally higher interest rates would be a good thing. It helps basically
Mm.
keep a time value to money. It's a really important thing to have. But because they've driven interest rates so low, we've had such a buildup of debt. And then therefore, when those interest rates try to rise, when you have extremely high debt levels, that causes also all sorts of solvency problems, liquidity problems that are important to
Hmm.
watch out for. And then two, because we have equity valuations that are so high, especially in the growth and tech stocks, so those are if you do the analysis of like discounted cash flow analysis, you're trying to determine what is your discount rates. So what is your expected rate of return?
Yeah.
If you're in an environment where treasuries are yielding 5%, you expect a pretty high return for those equities, and so you're willing to pay a lower price for them. But if treasuries are 1%, you're willing to pay a higher valuation for those tech stocks because you're doing that comparison. So suddenly when treasuries start rising, you're like, wait, well now I got to pay less for these tech stocks, and so you start to get kind of a sell off in some of those really expensive names. With yields pushing up and with inflation expectations pushing up, the market started to expect that the Fed might hike rates sooner than they said before they would. So before
Hmm.
the Fed said we're not even thinking about raising interest rates, and we're looking at multiple years with keeping interest rates at zero, and that's the short end of the curve, right? That's the part that they directly control, and they're saying we're not even going to do anything, and the market's saying, well, like inflation's starting to get a little bit spunky here, and so, maybe the Fed will end up having to raise interest rates. And so they started to price that in. And so when Powell gave his press conference, they basically pushed back on that and said, no, we're really not planning on raising interest rates until inflation actually runs a little bit hot. And so we're not worried about inflation expectations, and we're not worried about alternative ways to measure inflation. They're saying that the way we measure inflation, like the Fed measures inflation, that they're not really willing to raise interest rates until the way they measure inflation is well over 2% for a period of time. The other big thing was that there's a big open question about the SLR rule, which is basically a leverage ratio that applies to banks, and so that was temporarily suspended for a year, meaning that banks could hold more treasuries and reserves than they otherwise could. And that allowed them to essentially help finance the U.S. deficit. That helped basically, if you look at back a year ago in March, the treasury market essentially broke. It became illiquid. They're basically forced sellers, not enough buyers, especially for portions of the treasury market. And so the Fed had to come in and buy literally $1 trillion of treasuries in 3 weeks. And they also worked with banks and said, okay, we're going to take away this cap so that you can, temporarily have more treasuries, and that'll help smooth things out. And so there were some questions about whether or not that's going to be extended. And so I think for a lot of us, me included, our base case was they probably would extend it a little bit, but they actually decided they would not extend it. But then they kind of did a middle of the road thing where they said, okay, we're not going to extend it. However, we're open to comments. We don't want anything to break. So, we're willing to tweak it in the future if it starts causing an issue. And so they kind of took that middle of the road approach, which I found interesting.
How do they measure inflation?
Core PCE. And so it's like, they have a basket of goods, and then they factor out things like, kind of things they view as cyclical, like energy costs and things like that. And so they're saying, what is the non-energy, non-food change in a basket of goods that they define? And there are all sorts of, quirks about it. Like, my understanding is that they use Medicare payment rates as their definition of healthcare inflation, and so there's some wonky things in there that overall probably allow them to understate that a bit, especially if inflation is being driven by commodity prices, and so in general that would be a slower moving indicator, and so it actually sometimes it's higher than headline CPI if you have a month where you have like oil go negative, or basically if you have these kind of big declines in some of these more cyclical commodities, and so you can actually have core CPI be a little higher, whereas if you have the other way around where commodities shoot up and gasoline's expensive and people are actually having trouble driving as much as they want to because the gasoline's so high, well that really won't show up quickly in core PCE unless it persists long enough that then truckers, basically start raising shipping rates, and then that trickles into, stuff you buy on Amazon. And so it's their particular way of measuring it. And so whether or not someone agrees or disagrees with it, at least that's how they measure it, and that's how they said they're going to handle monetary policy until that measure reaches certain numbers. And so back when bonds were yielding 5%, you could say, okay, our target rate of return is 7% because we're hoping equities are going to yield 9%, bonds are going to yield 5%. If we do a 50-50 split, we'll get 7%, and it'll be good. But then we say, okay, actually, just kidding, bonds are yielding 1.5%. And then it's like, well, then I need to be more equity focused, and then they get into like hedge funds. They get into all these kind of different alternative investments. Some of them don't work out very well, and so they basically have to go up on the risk curve. And many of them are unwilling to put more money in, and basically, essentially admit that we're going to get lower returns. Therefore, we have to put more money in, or we have to reduce benefits. And so you have these kind of issues build up. And that's happening in multiple countries to different degree. I mean, that happens here in the United States. In fact, part of this recent bill they passed, the 1.9 trillion, there is a section of it for tens of billions of dollars that helps shore up, kind of one of the pension systems. And so it's not directly related to COVID. It's not like a COVID thing, but it's kind of like trying to patch this longer term issue. I broke it down into different types of inflation. So you have asset price inflation, then you have consumer goods inflation, and it largely depends on essentially money. If you increase the broad money supply by quite a bit, right? So if you go back to classical definitions of inflation, just an increase in the broad money supply is by definition inflation. And so often when people are arguing about inflation, they have different definitions and then they're talking past each other. So without a doubt, there's been monetary inflation. We've had money supply increases. And then the question is, where does that money go? And the answer is it goes into whatever's scarce at the time. And whoever has the money, what are their needs? And so because we've had an increase in wealth concentration, right? So a lot of that money kind of pooled up in the upper echelon, that a lot of that money went to financial assets. So things like art, wine, gold, high-end real estate, high-end cars, collectibles, equities, all sorts of things like that. Even bonds, because yields went down, bonds went up in price. And so, during that long period of time, we had significant asset price inflation. But now you have some investors are just tired of losing money and they're saying, well, I'm not going to invest in that anymore. And then two, you have ESG mandates. So people say, I'm not going to, so like the New York pension system says, we're not going to do oil investments anymore, and some sovereign wealth funds are saying we're not going to do oil investments anymore, and so those companies are less able to just keep issuing equity and just keep drilling, and so they say, wait, we have to actually finance ourselves from selling oil, and therefore we have to be more conservative with our capex. And so we've had this thing where oil demand has risen as lockdowns have eased, at the same time as a lot of that weak supply came off the market. Sometimes because capex projects were canceled, and just some of those wells kept going down in usage, and so now it's a little bit more tight than it was. And OPEC, some of them can increase production, but they've also purposely kind of held it flat so that they, in their view, hopefully drive prices a little bit higher.